it's Martin from Real Stock Value, and today I will talk about the methodology behind the Real Stock Value tool. So I will start with a quote for why to invest. This quote is from Warren Buffett. Over the long term, the stock market news will be good. In the 20th century, the United States endured 2 world wars and other traumatic, expensive military conflicts, the Depression, a dozen or so recessions, a financial panic, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. So this means that despite 2 world wars, despite the flu epidemic, despite a lot of recessions, the Dow Jones Industry Index went from 66 to 11,000. So that's why we need to be in the stock market. But how we can value a given company or a stock? So that's where the Real Stock Value tool comes in. Currently, most financial tools are based on technical analysis. The difference between them and the Real Stock Value tool is that the Real Stock Value tool is based on fundamental analysis or value investing. And all the really successful investors in the long run, they use value investing. Investors like Warren Buffett, Jimmy Rogers, Mark Faber, Ben Graham, and so on. I also would like to include here a quote from Jimmy Rogers. I haven't met a rich technician. This means that all the really successful investors also use fundamental analysis. Technical analysis is just not enough. This is where the Real Stock Value comes in. So it uses 4 well-known metrics, which are the price to earning ratio, the price to book value ratio, the price to sales ratio, and dividends. And based on this, computes the value of a company. So these 4 metrics are used as the basis of this tool. So let's take each of these separately. I will start with the PE ratio, or price to earnings ratio. This is the most important and most heavily used metric. So this means how much do we pay for a given income stream. So the price is what we pay and the earnings is the income stream. So the price to earning ratio means how much do we pay for a given income stream. Another interesting metric is the price to book value ratio. The price to book value ratio gives us a hint how much do we pay for the assets of a company or the index. So assets include real estate, plant and equipment, intellectual property, brand name, and everything else that you can think of. And it also gives us a hint how much will it cost to recreate that given company. Another metric is the price to sales ratio, and this is the preferred metric of Mark Faber, because price to earning ratio or even book value can be manipulated. However, it's really hard to manipulate your sales numbers. For every industry there is a profit margin that you can expect, and if the profit margin gets too high, some new competition will appear and it will push down that profit margin. So that's why even if your current profit margin is really high, probably it will come down in the future. And the last metric that I use in this tool is the dividends. So in ideal tax conditions, the asset is the stock or the company, and the income stream is the dividend here. So ideally, companies should give back all the earnings in form of dividends to their shareholders. This is not true because of taxation reasons, which I will discuss in a later video. A healthy dividend also shows that a company is actually profitable, not just on paper, and it's willing to return these profits to the shareholders via dividends. There are some other effects that we can include in this tool. One is the growth expectation, another one is inflation, and also the long-term treasury yields can be an interesting component. This will be included in a more advanced version of the tool. And there are also a few more hints that we can use to see if something is a good investment. One is insider holdings. So how much of the stocks insider are holding, because if it's a high percentage, it means that the directors and so on trust the company and they are holding their own money in the company, so we should invest with them. And also there is insider buying or insider selling. If we see insider buying, usually it's a good time to buy. If we see heavy insider selling, probably it's a good idea to sell. And there is one more thing, the short interest. So if the fundamentals are right in a company, so we like a company, and the short interest is really high, then probably the company price will rebound shortly. Hi, it's Martin from Real Stock Value. I hope that you enjoyed this video. If you liked it, please give a thumb up. Also subscribe to our channel and visit our webpage to learn more about Real Stock Value. Thank you.